Hello and welcome to the Kroll Lens, our podcast navigating the regulatory landscape, part of our series with Kroll's experts to help you navigate the evolving regulatory environment. As an award-winning provider of compliance and regulatory consulting services to the financial services industry, Kroll helps clients develop, implement, and manage their compliance and regulatory consulting programs.
Hello and welcome to the Kroll Lens Consumer Duty series, featuring technical discussions with guest subject experts focusing on the approach in consumer duty and its impact on regulated firms. I am Matt Austen, a Senior Vice President in the UK Regulatory Consulting team, and I will be your usual host. Today we'll be looking at how the consumer duty will impact firms' thought processes when looking to buy or sell a regulated business or book of products or services. The FCA has been clear that the consumer duty will touch on all elements of a firm's business where there is a retail customer at the end of the process, and it hasn't escaped our attention that, for the first time, the FCA has written rules into the final consumer duty legal instrument requiring firms looking to sell their retail products or services to another firm to work with the other party to the potential transaction to ensure the duty has been complied with. With this in mind, it seems regulatory due diligence is more important than ever, allowing both parties to enter into a fully informed negotiating position whereby evidence of the current regulatory health of the business and its treatment of customers can be established and documented. To help me further explore this topic today, I'm pleased to be joined by one of our directors, Richard Taylor. Good morning, Rich, and thanks for joining me.
Good morning, thanks for having me.
You're welcome. Richard has extensive experience conducting regulatory due diligence reviews across a range of topics, including governance, conduct, and anti-money laundering. Additionally, Rich is one of our resident risk and SMCR subject matter experts, bringing many years of experience from working in both operations and oversight roles within regulated firms. Before we get into the weeds of the consumer duty, impact on the buy or sell side businesses, I wanted to briefly discuss why regulatory due diligence is important in the first place and what our clients hope to achieve from conducting a health check into their regulatory systems and controls. So, Rich, you've worked with buy and sell side firms a lot over the years on regulatory due diligence projects. In your experience, what risks are they looking to mitigate through the regulatory due diligence process? What types of output do they generally want?
Yeah, thanks very much, Matt. So, to get the exciting bit out of the way first, let's start with a sort of definition of terms. So, where we're talking about regulatory due diligence here, you said at the beginning, it's looking into firms where there's activity either to take a significant stake in the firm or to buy a regulated firm or buy a business from a regulated firm. Now, there's other forms of due diligence out there. So many people listening to this might be more familiar with operational due diligence, which takes on many forms and covers generally regulatory risk as well. But operational due diligence, when, for instance, a firm is looking to invest through an investment fund manager, take a significant mandate, or enter into a joint vehicle with them, and also due diligence activities that would take place for vendors or outsourced service providers. So due diligence takes many different forms. And there's also, on top of that, other areas of transactional due diligence, so legal due diligence, tax due diligence, and all that fun stuff. At its core, all of those processes are effectively trying to reach the same question or an answer to the same question, which is, what is the risk that we might be taking on here? So what is the operational risk, what is the legal risk, and various others. What we look at specifically and what we try to concentrate on for these kind of transactions is the regulatory risk, and it's a recognition of the fact that we're conducting a standard operational due diligence process. For a regulated firm, just about all of those processes, including the risk management of the processes themselves, are relatively heavily regulated, or something that regulators would want to look at. So we're really looking at here, what kind of regulatory risk would we be taking on as a firm, as the buyer, in taking over this firm, in taking a stake in this firm, or in taking on this in this book of business. So the reason that firms work with us, and the reason that we sort of collaborate so closely with various firms in these processes, is what we are able to do is look at not only our experience from a regulatory and compliance standpoint of where the firm's processes are and what they should be, but also in marking that firm against its peers. what is sound industry practice? What are they doing against that? And then how are they complying with, in this case, the FCA, but also globally, how are they complying with the expectations of the regulator? In terms of our output and what we are sort of delivering to clients and what clients are seeking to achieve, what we generally put together, well, it's agile depending on client need, but what we generally would put together is some form of report which addresses either specific concerns or looks at the firm's regulatory compliance as a whole. So that report serves several functions. First of all, it's a documented record that can be used for observations and opinions and really set out the work that might need to be done. It's useful in the transactional process in terms of a buyer firm knowing what input might be needed, what potentially the effort involved in that input is, and then, of course, the cost implications of that. There's also the requirement for, often, there's also the requirement for that report to be handed to other funders in the transaction. So it's often cases that a transaction will be taking place with one party, but there are various backers, be it banks or insurance companies, etc., that are involved in the transaction that would also want to be able to see what kind of risks are involved in being involved in that transaction. So the type of report that's produced can vary, as I said, in scope depending on the needs. We have a full scope report, which will set out not only what the client's doing badly, if you will, but what the client's doing well, and how those processes work, to what's called a red flag report, and which just sets out key areas of risk that we see that the buyer may want to focus on. As I said, that approach varies depending on the type of business that's involved. So we deal with sort of many different types of regulated business, but also on the specific needs of the client. We'll generally look at quite a few different areas, but if we look at the sort of the key areas that I think going to be interested in this conversation, we'll be looking at the senior management and governance arrangements, the enterprise and operational risk arrangements, obviously compliance arrangements and regulatory arrangements in terms of their positions, their registration and their permissions, their awareness, regulatory change, any correspondence and visits. And then we'll touch on key regulatory topics. So previously that's been things like AML, or treating customers fairly, which is now the consumer duty, which will be a sort of large part of, I would have thought, of regulatory due diligence going forward.
Good stuff, thank you. I think one other thing as well is just to re-emphasise, I mean, you mentioned reputational risk is one of the reasons that clients will often want to conduct due diligence, particularly if they are looking to buy, they are the buyer. I mean, there have been a couple of cases out there in the wider world that have emphasised the need for in-depth and impartial due diligence services. There's one playing out that people may be aware of over in the US at the moment, which is where a startup business is being sued by a quite large-scale investment bank who are claiming fraud and possible misrepresentation. Obviously, we're going to have to see where that lands, but the fact that legal action has started suggests this could be a costly and reputationally damaging episode for the investment bank concerned, which could have been avoided by asking more robust questions, perhaps in the pre-purchase stages of the transaction, and perhaps plays to what you're saying. You know, the reasons for undertaking due diligence is having that information to hand, having that insight is really important, and I guess sometimes walking away might be the best decision, but you need information and data to support that view.
Yeah, no, I wouldn't want to comment on sort of what due diligence was undertaken there, but I think it's a good point you raised, Matt, in terms of reputational risk. Now, often these things fall down to what is the regulatory risk, what's the risk of fines, what's the risk of us getting in trouble, really. But the reputational risk there is also an important factor in it. Without looking at these businesses or these books of businesses appropriately, you run the risk of something going wrong, an increase of customer complaints, for instance, which then start to impact onto your business reputationally, despite the fact that the reason or the initial reason for those complaints might have actually had nothing to do with you.
So I guess to sort of summarise this section, which I think is a really useful introduction to what due diligence is and why you might do it for those people that perhaps aren't overly familiar, is I guess that without making inquiries you are unlikely to know where the issues might be. And we might say that, at least corporately speaking, due diligence is likely to be more cost effective than litigation that could come later, or indeed dealing with regulatory enforcement.
Yes, absolutely. And let's obviously not forget that in the UK, we have the reasonable steps under SMCR to ensure that businesses are running as they should be, and really due diligence and asking the right questions is just part of those steps.
Yeah, thank you. So I guess then moving our focus to the Consumer Duty, I think it's fair to say that as of today, pre the July deadline, as we are here, there is no strict requirement set by the regulators that a regulated or unregulated business conduct due diligence to ensure that a business they are perhaps looking to acquire is currently meeting regulatory rules and guidelines. Does the Consumer Duty perhaps change this a little bit?
Yeah, I think that's right. It's one of the things that I think the FCA have pointed out quite rightly is that, and it's true of any regulation to be fair, but an unintended consequence of the Consumer Duty may well be to exit from the market. That being firms that either the requirements of the duty they find to be too onerous, or they simply can't comply with them, or they're just looking to scale back their sort of regulatory footprint. I mean, we've seen that before with other large regulatory change. I mean, I'm showing my age here somewhat, but if you cast your mind back to the days of RDR, we saw a consumer focused, I think it's fair to say, regulation came out impacting financial advisors. And as a part of that, there were new regulations on what the financial advisors needed to do, how they treated customers, how they dealt with rebates, etc., etc. And that led to quite a number of advisors leaving the market, and whether or not that's selling their business to nationals and networks, or selling the book of their business and concentrating in a specific area. So the FCA recognises that, as I said, an unintended consequence of the duty might be that happening. Now, with the duty, I think the FCA's concern would be that if due diligence or appropriate protections are not put in place, a customer who was previously with a provider who was then sold as a book of business to another provider, or that provider has a new owner come in or something, the FCA's concern is that they shouldn't have any less protection than any other customer. That the Consumer Duty effectively follows the consumer rather than the owner of the business, if you will. So where there's not previously been sort of stringent requirements or requirements laid down for what kind of due diligence needs to be in place, the FCA is really seeking to remove any ambiguity in that existing framework and put in their final rules an expectation that the duty will apply where a firm sells its products or services to another firm. So what they're looking to do here is put an obligation onto the seller and onto the buyer to get the transaction coming from both directions. So what they'll look to do is ensure that the seller of a book to another firm will need to provide the information to the potential buyer, which to help them comply with the duty, and then the buyer themselves will be required to gather that information and analyse it and ensure that they are happy that their customers are being treated as they should be. Really, that's going to involve things like ensuring that the customers, well, ensuring that previously processes were in place for customer understanding, that customers are gaining fair value from these products before they take them onto their books. We're talking about fair value there and customer understanding. In order to really understand that when buying a book of business, it's not going to be simply looking at that book of business, looking at the products and services they're invested in, making assumptions. Really, buyers are going to want to know, they're going to have to know things about the governance structure of the company that they are buying a book of business from. Now, normally you would do that, if you were buying the business outright, but I'm just talking here about a part of it. You would still want to know what governance arrangements are in place, what their compliance and risk arrangements look like in order to support the framework of good customer outcomes, which is sort of where the duty is aiming, and to ensure that they are being delivered and they were being delivered, so that you are not going to be hit with problems down the line, which would then sort of become your problems, if you will. that's going to have to factor into whether or not they go ahead with the purchase. And for sellers, that's going to have to factor into when they're selling their book in order to have the right information there and be able to give buyers that comfort that they're not taking on additional regulatory risk through this process.
Mm. And I know from the regulatory due diligence projects that I've worked on, certainly where we've been working for a firm that is looking to be acquired rather than someone that is looking to buy necessarily. So effectively looking to present themselves, I think, in a true but fair light to the potential buyer. There's often that useful analysis that comes with the reporting of where the issues are and actually how big a problem is, or in other words, how much work it needs to fix it. I think that's probably something that a buyer is going to look to want to see.
Yes, absolutely.
Lovely, thank you. So I think as things evolve, as we move past D-Day, which is 31st of July, the implementation for new and existing products, how do you think a regulatory due diligence report will change in the coming months and years as a result of consumer duty? I mean, earlier on you touched on some of the things that we would expect to see in a report. Clearly, the landscape is shifting, is moving on from TCF, where retail is concerned. What do you think the due diligence report looks like as we move past that deadline?
Yeah, it's an interesting one. Now, some aspects of it are always going to be present, but it perhaps is how those areas interconnect. And what I mean by that is, as you say, we touched on some areas earlier. So there's governance and oversight and senior management accountabilities under SMCR. Really, I think what's going to have to be at the core of this, from a consumer duty side, is that piece on what are firms doing to implement the duty on an ongoing basis. How have they identified good customer outcomes, and then the processes and frameworks they put in place to support that. What brings it all together is the risk management processes, well, in my mind, which is risk taking that consumer duty lens to oversee everything that the firm does. So it's not that the fact that you would do a due diligence report and you would report on senior management and governance arrangements, regulatory arrangements, compliance policies and procedures, risk and compliance functions, etc. separately. Some of that will still be there, but the consumer duty wouldn't in and of itself be really a separate section in that. It would be a part of everything that firm does at its core. And I mean, that's really the difference between this regulation and others we've seen come down the line, which is that it cross-cuts across everything that a firm should be doing. So I think it's putting that lens into the due diligence process to ensure that you are covering that as you go through oversight and governance, SMCR, making sure they have the right people at the right level, the right skills and experience, looking at that risk and compliance function, really to understand if they are taking on the consumer duty responsibilities applicable to them and whether or not they're giving the right advice and guidance to the business. And again, how the consumer duty is weaved into the compliance policies and procedures, and the effective sort of oversight culture within the firm, be that sort of first, second, and third line, and how the firm's using management information and reporting to inform the oversight and governance piece that we touched on earlier, and then evidence good customer outcomes and how they are being delivered. Currently, what we're doing as this sort of firms are gearing up for this is we are reviewing implementation plans to ensure they cover all key areas and whether or not the deliverability of that looks reasonable. I think once we're past that, it will be very much how embedded is this, on the understanding that sort of when the FCA comes to knock, they will be looking at consumer duty not as an individual thing, but they will be looking at your entire business and how consumer duty sits within it.
Exactly. I think there's that. I mean, the FCA has been clear it wants a cultural shift with consumer duty, and I think we then kind of move to the word embedded, don't we? Once we get past that deadline, I think as well. Once we move past the 31st of July, our next deadline in the consumer duty story is July 2024, which is when the first mandated board commission report will be due. And I guess in the run-up to that, we'll be looking to comment on preparations for this, what information will be going into the report and the governance and structure around its creation, scrutiny and approval. I think that's going to be a significant challenge for firms in the run-up to that next deadline. I think the other one as well is, of course, the 31st of July is, as I said earlier, the deadline for firms that have new and existing products and services. But for those with closed books of business, they've got an extension until July 2024. So equally, it probably fits a bit more into the topic under discussion here. If there are businesses who have closed books, they've got a bit longer to work on their act. And I guess our reports in the run-up to that will be very much focused on the continuing implementation plan for those firms.
Yeah, absolutely. That board report's going to be a very important date, and I'm sure firms are aware of that. But the planning that's going into it, and how the management information, ensuring that they have the correct dashboards and all the different things that they need in order to inform that report, because it is going to be a document that is out there. It will be something that can be requested, and it will be the first time the FCA can really start visiting firms after the implementation plan and their initial feedback after doing a review of those implementation plans. It's really the first time that the FCA can come around and start seeing specific pieces of paper, if you will, that are talking about how the firm has done this and anything that they need to remediate.
Yeah, I mean, it's going to be, I think, a fairly clear indication on paper as to how you've actually implemented the consumer duty, full stop. If that report isn't speaking to what the FCA wants to see, e.g. customer outcomes, I think that's going to be a fairly clear red flag to them that perhaps the firm hasn't implemented the duty as they would wish. So I think you're right that getting that report right around that time is really crucial, and MI is a crucial part of that. As you know, Rich, we've been talking to customers about consumer duty and the importance of MI, and I don't think we can stress enough, without the right MI now, I think you're really going to struggle to create that report later on.
Yeah, absolutely.
So it seems then, I think, from our conversation that it's fair to say the consumer duty will raise the standard of when and how due diligence is needed, and it will likely make it even more important for firms on the buy side to ensure that non-compliance with such regulations do not result in additional liabilities or exposure to FCA enforcement later down the track. I guess for those vendors looking to sell, they will want to be able to attract buyers easily by giving them a sense of comfort around potential risk areas, as well as avoiding the buyer being able to easily chip away at the agreed price due to a lack of quality and impartial information.
Yeah, absolutely. And just one thing to add on this, on books of business, that I just wanted to mention, the consumer duty and the FCA interest in the firms buying books of business is, well, the consumer duty is new, but the FCA's interest here is not. We've seen quite a few cases over the course of the last few years of the FCA discussing with firms the due diligence that they put in place in their acquisition framework when it comes to buying large books of business, especially where that's led to operational problems, an increase in requirements for operational service providers, and this ties into the operational resiliency planning to some extent. We have seen that in a few cases of the FCA, but generally what they've been looking at previously is, how are you intending on managing these problems going forward, and how have you, acquired this business, and how did you look internally to decide whether or not you could run this effectively. I think where there will be a change here is that focus will remain, but also there'll be a more of a focus on what did you do initially to ensure that these problems wouldn't happen. Where was your due diligence? What does your acquisition framework look like? How did your board or other management body engage with this process to ensure that really customers were getting the best outcome from it?
Yeah, absolutely. I mean, I recall when I was at the FCA and I was in the consumer investments team, there was some work undertaken at quite high level, to be honest, in 2017, looking at investment firms' advisory practices when acquiring new books of clients from other firms. I mean, it didn't result in anything new at the time. There weren't any rules that came out of it. It was quite a high-level deep dive, but it kind of restated expectations at the time. But I think, as you say, over time, there has been that slow evolution of FCA's expectations when books of clients are acquired. The practice that is utilised, I suspect, that's partly culminated in the work on closed books, the fair treatment of closed book customers, which I think was sort of around 2016, 17, similar time. I guess the FCA probably hasn't seen the work take place that it wants to see, and is now using the Consumer Duty as a new tool to, I guess, mandate that work takes place. And due diligence is the tool, I think, for firms to be able to prove that they have looked at the book they're looking to buy, or indeed, if they're being acquired, that they have done the work that is necessary.
Yeah, absolutely.
Good stuff. Well, look, thank you, Rich, for joining me today. I'm sure that for our listeners, the insight shared has been useful. It seems to me that regulatory due diligence is going to be more important than ever once the duty lands at the end of July, both to buy-side and sell-side businesses, regardless of whether the transaction is for a specific book of retail clients or actually whether it's, as you've said, Rich, for wider business acquisition. There are absolutely those other elements, such as the governance framework, that need to be considered. For those listening, thank you for joining us. Please do subscribe to our series on the YouTube platform and share episodes across your professional network. Also, give us a thumbs up rating, as it helps others using the platform to find and utilise our insights. If you would like to hear more from us, please look out for our regular insight articles on the website, where you can also find details of how to contact us if you wish to discuss anything you have heard here today. We will be back in the near future. From myself and Rich, thank you and goodbye.
Kroll's regulatory advice and consulting specialists provide insight on regulatory change approaching the financial services industry and discuss the FCA's intention to place clear accountability for compliant implementation of the consumer duty. Check out our featured insights by clicking on the link in the description.